Hi, I'm Rachel Spears. I'm the Executive Director of Pro Bono Partnership of Atlanta, and I'm going to talk to you today about payroll pitfalls. First, I want to tell you a little bit about our organization. On slide 2, you'll find our mission, which is to provide free legal services to nonprofits by connecting them to volunteer attorneys. On slide 3, you can find out information about our eligibility requirements and how to apply for our services. You can also go to our website to find more recordings and articles on various legal issues for nonprofits. Finally, we also list on there our upcoming workshops and webinars. If you'd like to join our mailing list, there's an email address that you can contact. I'd like to point out that this webcast is for information only. It's not legal advice. Just general guidelines. All right, on slide 4, I would like to talk to you about some real stories that happened to our clients that demonstrate why this is such an important topic. First, we had a client, they ran their own payroll, but the IRS contacted them because their Forms 941 didn't match up against the information on their W-2s. The IRS sent a bill for $170,000. Turns out it was just a clerical error. They really didn't owe anything to the IRS, but it took a couple of years just to resolve that with the IRS. Second, we had a nonprofit that shut down, ran out of money and shut down. And a few months later, the former executive director received a bill in the mail from the unemployment department saying he owed $1,000 for unpaid unemployment taxes. The organization had failed to pay prior to shutting down. Unfortunately, as executive director, he was personally liable for those unpaid payroll taxes, so he had to come out of pocket for the $1,000. Third, we had something that actually happens quite a bit. A nonprofit was treating somebody as a contractor. When they let that person go, they went and filed for unemployment, and the Department of Labor said that that person should have been an employee, and therefore they were eligible to receive unemployment payments. The IRS got wind of it and sent a bill for the unpaid payroll taxes on that contractor's pay. And all of that added up to so much money that almost shut down the organization. Finally, we had a client whose past executive director was treated as a contractor. They did not take out payroll taxes. One thing I want to make sure you understand today is that executive directors are always employees. So do not treat your executive director as a contractor. This organization did, and the IRS found out and sent a bill for $30,000. But because the organization, all their funding is restricted, they can't pay it, and this may in fact shut down the organization. I tell you these stories to demonstrate how important this topic is, and it's really the area where we see our clients get in the most trouble. On slide 5, I have a question I need you to ask before you pay anyone. When you start out as a nonprofit and there's not enough money to pay anything, things are actually pretty easy. But things get complicated once you start paying people. So before you pay anybody, the first thing you need to ask is this person a volunteer, an intern, a contractor, or an employee? And on slide 6, I want to talk a little bit more about each of those. Now, you might think that's pretty easy to figure out if somebody's a volunteer. You don't pay them anything if they're a volunteer, but I have a lot of clients that muddle that a little bit by giving them some form of compensation. They might give them some money at the holidays. They might give them a gift card or some sort of a stipend. It's important to remember that according to the IRS, all of those things are compensation. And you could inadvertently make a volunteer start to look like an employee, in which case you have to make sure you're paying minimum wage, you got to take out payroll taxes. There's really opens a can of worms. So find a way to reward your volunteers without paying them. Second, similarly, interns are usually volunteers, but I do have clients who want to pay stipends to interns. While there are some limited situations where you might be able to do that and not worry about minimum wage, those situations, those instances are limited, and you really should only do so under the counsel of an attorney. It's much easier just not to pay stipends at all. Find other ways, again, to reward your interns. For instance, if they're getting course credit, college credit for the internship, then that's another way that they can be compensated without money. Next, the area where people get in the most trouble is treating somebody as a contractor. You need to know that if you're paying someone, chances are great that they are an employee. If you're treating them as a contractor, you need to be very sure that they meet the qualifications of a contractor. We'll talk about those more in a little bit, but be very careful. Finally, with an employee, as I said, that's going to be most of the people you're paying. You need to ask, once you determine they're an employee, I would just throw in here that you need to ask whether they're exempt or non-exempt. That means, well, whether they're eligible for overtime or not. This is really outside the scope of this webcast, but we do have clients have problems not paying overtime. Most of your employees are going to be eligible for overtime, so keep that in mind. On slide 7, I want to talk to you about payroll taxes. So once you determine that someone is an employee, you need to take out both federal and state payroll taxes from their pay. You also are going to have a lot of forms to fill out, which we'll talk about. Now, the definition of wages according to the IRS is very broad. That means just about everything you pay them is going to be subject to payroll taxes. That includes cash or non-cash benefits, and we'll talk about some specific types of things, but it can include a holiday bonus, could include, again, gift cards, which the IRS considers compensation. All of that's going to be taxable. So if you give your staff some money around the holidays, you're going to make sure you run that through payroll. On slide 8, while almost everything, as I said, you pay is going to be considered taxable wages, the IRS does lay out some exclusions from payroll. So these include health insurance premiums. If the employer pays health insurance premiums on the employee, or if they take the employee's share of payroll premiums out of their payroll, that can be deducted pre-tax, as they're not taxable wages in most instances. That also includes parking reimbursements can be deducted pre-tax. Fringes such as personal use of company cell phones, expense reimbursements, meals and lodging on business, those types of things will not be considered part of taxable wages. The IRS has a whole booklet on these things, so you want to make sure anything that you're not treating as taxable wages fits very neatly in one of those categories. Now on page 9, I talk a little bit more about the payroll taxes you need to take out of taxable wages. Federal and state income tax, the employer is responsible for withholding that from the employee's wages. So the pay that is going to the employee, the IRS and the state government holds the employer responsible for taking that out. The employer is also responsible for taking out the employee's share of FICA taxes. FICA includes Social Security and Medicare, excuse me. If the employer fails to do that, they will end up having to pay those amounts, or could end up having to pay those amounts to cover what the employee should have paid. The employer is also responsible, of course, for their share of FICA taxes and any state unemployment taxes. And I talk a little bit more about that on slide 10. For both Social Security and Medicare, the employer and the employee each share half of the amount. So For Social Security taxes, the employee is responsible for 6.2% of their wages going to Social Security. That's withheld from their pay. And on top of that, the employer pays 6.2% for a total of 12.4%. Similarly, for Medicare taxes, both the employer and the employee are responsible for 1.45% of all wages in most cases, adding up to 2.9%. On slide 11, I want to talk about unemployment taxes. As I mentioned, the employer is responsible for paying any applicable unemployment taxes on payroll. Now, 501c3 organizations are exempt from paying federal unemployment tax, also known as FUTA. They don't have to worry about that, but the rules are different and vary from state to state on state unemployment tax. Here in Georgia, employers are responsible for unemployment once they reach 4 employees. At that point, nonprofits can choose to either take out, pay unemployment tax with every payroll, like a for-profit employer would, or they have the option of choosing the reimbursable method. In that case, they don't pay unemployment tax, but if an employee files for unemployment, the Department of Labor will get reimbursement from the employer for all of that unemployment payments. So in any event, the nonprofit must choose, once it hits 4 employees, it must choose which one it's going to do, notify the Department of Labor, and if they choose to pay unemployment tax, they of course need to do that with each payroll. On slide 12, we get to payroll tax deadlines. When the employer withholds these payroll taxes, they are responsible for remitting that to the government. And in some cases, the deadline can be the next business day. So it's a quick turnaround, and there can be severe penalties for failure to do so. On slide 13, I mentioned this earlier, but the employer is secondarily liable for failing to pay the income tax withholding and for the employee's share of FICA taxes. So if they fail to withhold those taxes from the employee's payroll, they could end up having to pay it. The employer is also liable, of course, for failing to pay its share of FICA and unemployment taxes. And in both cases, significant penalties can be assessed if they fail to do so. Now, slide 14 should get your attention if you're an executive director of a board member of a nonprofit. Because executive directors and in some cases board members can be held personally liable for unpaid payroll taxes. Now, you might think that as a corporation, board members and officers have freedom from personal liability, but here's an exception. In the case of payroll taxes, the IRS and state government can come after you personally for those. So it's really in your best interest to make sure the organization is current on all payroll taxes. On slide 15, I just mentioned a few of the forms. There are, of course, state payroll tax forms you have to be on top of. On the federal side, there's the 941, which is a quarterly payroll tax return. If you're a small employer, you can sometimes do the form 944 instead. Then on an annual basis, you'll do the form W-2 and a form W-3. The form W-2, of course, goes to your employees, the wage and tax statement. Now, what you need to keep in mind is you need to make sure the data on your forms 941 matches your W-2s. This is where one of the stories I mentioned earlier where the client got sent a bill for $170,000 because they did not match up. So make sure when you're submitting the W-2 that it matches up against what was on those 941s for the prior year. The IRS is also comparing those forms against the Form 990 that the organization completes on an annual basis. So the portion where you include compensation of highest paid individuals, you want to make sure that information matches what's on your W-2 and your 941s, or you're going to hear from the IRS. There are penalties for failing to file, filing late, or filing incomplete or inaccurate statements. So I keep saying this, but there are penalties for all sorts of things, which is why you want to be very careful about doing your payroll taxes properly. Next, on slide 16, I want to talk about some best practices. First, compile a list of all the benefits you provide to your employees and determine whether they're included in taxable wages or not. Second, review your payroll processes, the timing of the payroll tax deposits, making sure you're completing all the necessary forms correctly and on time. Next, as we just mentioned, review your forms W-2, 941s, and 990s and make sure the information matches up. And finally, document all your procedures. If you do have a problem with the IRS, it really helps to be able to show them what procedures you have in place. On slide 17, my recommendation is always to use a payroll service. Even when we had one employee, we used a payroll tax service because I was so nervous about messing things up. And I recommend that other organizations do the same unless the employee happens to be a payroll tax expert or somebody does. There's just a lot of ways to mess up here. Now, of course, the employer is ultimately responsible for filing those payroll taxes on time and correctly. So you don't want to just rely totally on the payroll tax provider, but there are ways to kind of check on them. There's something called the EFTPS, electronic filing of payroll, where you should, as an employer, register and you can check your filings, kind of go back behind your payroll tax provider and make sure those filings are made. Finally, and importantly, it's a best practice to review your worker classifications. If you are treating somebody as a contractor, make sure they qualify to be treated as a contractor. And if there's any question at all, get legal advice. On slide 18, I'm going to follow up with a little bit more information about contractors because it is such a big problem that we see. Yesterday, I listened in on a teleconference the IRS gave on employment taxes, and they spent a good chunk of the time talking about contractor misclassification. This is something they are really focused on right now. So keep in mind that if you're paying someone, chances are they are an employee. You're treating them as a contractor. Usually the question of whether they can be a contractor or not comes down to who has control in the relationship. If the organization has the right to direct and control the worker, then they're an employee. The IRS has a 20-factor test in determining whether somebody is a contractor or an employee. You have to look at all of those factors together to determine whether somebody qualifies. In most cases, you kind of come down in the middle. If you're in those gray areas, I think it's really important to seek advice from an expert before you classify somebody as a contractor. Someone just told me the other day that one question to ask before you treat somebody as a contractor is, do you feel like it's a arm's length transaction between two different corporations? If you do, then that person may very well be a contractor. You know, somebody to handle your landscaping outside your corporate office or something, or a bookkeeping service or something might qualify. But if it's more like you're hiring an individual to do some work for you, they're going to be an employee. We do have some more information on the use of contractors on slide 19, along with several other resources that just dig deeper into some of the topics we've discussed today, and I encourage you to check those out. On slide 20, we have resources from the IRS on some of these same topics. Finally, on slide 21, you have contact information for us. If you're a client of Pro Bono Partnership and have questions about payroll taxes, I encourage you to follow us up and we will try to help you out. Thank you for your time.